each one of these political relations and how Trump handles them relative to how they were handled under a Biden-Harris administration, well, that could open a whole new can of worms in terms of which way markets are going to go, not just oil markets, of course, but other markets as well. Hello and welcome to our 10th episode of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital Group. I'm joined today by Onyx Research Associates, Vincent and Mita Chaturvedi. Before we start the show, as usual, please like and subscribe to the podcast. I invite you to also visit Onyx's LinkedIn and YouTube channels for more exciting content. In this episode, we're going to review the fallout from the retaliatory strike that Israel conducted on Saturday in response to Iran's missile attack on the 1st of October. When the market opened on Monday, I think that it's fair to say that there was a big rush towards the exit, especially of the bulls, that had been betting on a response that would further escalate the geopolitical risk premium in the oil price. Instead, Israel conducted aerial attacks that stayed clear of oil infrastructure, nuclear installations, or even Iranian leadership. So despite virulent rhetoric from Iran in the aftermath of the strike, there does not seem to be any appetite on either side, at least for now, for further escalation, which essentially leaves the market right where it was before the Iranian missile attacks. The ensuing price action was quite abrupt and dramatic. The December 2024 Brent contracts collapsing towards $73 per barrel compared to a close last Friday of just above $76 per barrel. Monday also marked the expiry of options on the Brent deck futures contract, with clusters of open interest around $75 and $70 strikes that likely generated sales by put underwriters. This in turn also probably led to algos chasing the price lower. Now, this does not mean that the market is discarding risk altogether. The options market still shows a positive call skew, albeit a small one, for the January 2025 contract. However, now that the known unknown of Israel's response to Iran has been resolved, the market is back to its former regime, at least in our view. So the market closed on Monday at around $72 per barrel, and at the time of the podcast recording was trading just under $72.50. Has the dust settled, or do we face further downside? Is $60, a potential handle? The price action on Monday came against a background of still weak positioning by money managers and CTAs on the crude oil contract. The inherent hesitancy in deploying directional risk is still very much part of the market narrative and is likely to continue to play a decisive role in shaping the direction of price. So let us begin the show. Speaking of positioning, let us examine the data running up to the weekend. And so I've observed personally in the past few months that the positioning has sort of been moving up and down with geopolitical tensions. And whenever these tensions have increased, the money managers gingerly increase their net long exposure, only to fade that exposure pretty quickly thereafter. So Vincent, can you walk us through the recent positioning leading up to the past weekend? What have we seen money managers do?
Certainly. So money managers overall got shorter in the crude benchmarks, Brent and WTI futures over the past week, potentially pricing in the reducing their long positions on the idea that Israel's retaliatory strike against Iran would be more proportional and would not hit oil or nuclear facilities, therefore reducing the fears of supply disruption. So with this factor now keeping, previously it has propped up prices, now this factor is gone, the market is now turning their attention towards sluggish global oil demand growth, weaker consumption, and the potential return of OPEC barrels towards the end of the year. But up until last weekend, they were pretty much quite tentative in a wait-and-see mode.
Okay. So in terms of when looking at the long to short ratios, are we still basically at those historical lows? Has anything really changed in the past 4 weeks, I would even say?
Not particularly, still at these historical lows, as you say. Week on week in Brent, it was a very marginal change, so around 2.3 to 1. That's a long to short ratio, 16th percentile for all weeks since the past decade. Actually, the main driver in the market getting shorter was the reduction of length and addition of shorts in WTI futures. Instead of Brent, and WTI longs have declined for the fourth consecutive week, perhaps coming on the back of rising US inventories and both in commercial and in Cushing.
Okay. So, I mean, that's the COT data, the commitment of traders data given to us by the exchanges or the CFTC. When it comes to now CTAs, right? Onyx has its own proprietary measure of CTA positioning. What was the positioning there? Did it fairly mimic what we see or what we saw in terms of the commitment of traders data?
I believe so. Over the past week, leading up to last weekend, positions in CDAs were relatively unchanged for the futures benchmark. Also very much in a wait-and-see mode until Monday, where we saw a notable drop-off in their net positioning. However, they have been more bearish during past declines in price action, which means that they retain the capacity to deploy more directional risk. And what we think there might be more capacity for bearish positioning in the case of further drops in price action, especially if it goes below 70, then the CDA positions will be crucial in driving that momentum.
So I'll turn to Mita here for her opinion. I mean, you've been tracking these positions as well. We've been often talking about a sort of saturation point in terms of the positioning and basically how short money managers or even CTAs could get. So would you agree with Vincent that we may actually have a reset in terms of what the lower end of the positioning is going to be, where we used to be saturated? Well, we may have more scope now for these type of participants to get even more bearish.
Yes, I would agree with that. I think we have spoken about a potential every time we speak about a potential saturation, a lot of times, especially around September, we saw that floor break and positioning get a lot more bearish. I think with just after that, just with the rise in geopolitical risk into October, we saw some breathing room in a lot of these in the CTA positioning, which I think, while it's great for net positioning, is also at the same time allowing more space for these participants to get more bearish. So I would agree that it does give us room for it to get more bearish.
Yeah. Because for me, once we start changing basically the goalposts of where saturation is, right? A lot of people are saying, well, being max short or as short as you could be on a historical basis, any sort of positive or price constructive event, whether it be geopolitical, fundamental, weather related, doesn't really matter, is going to lead to violent correction upwards in the price. And maybe a lot of people are banking on that. But once you move the goalpost and say, well, there's actually room for more, then we're setting ourselves up for the possibility, of course, that we face an even weaker price outlook than maybe some people have thought. Yeah. Now that, I mean, we have the background on positioning, Mita, let's delve into the details in terms of what happened over the weekend. Could you give us, more of the details of Israel's strike on Iran? What's certainly interesting for me was that this was an aerial strike, right? And not a missile strike. So sort of demonstrating, or maybe, at least in my view, Israel demonstrating its ability to reach into Iran, deeply into Iran, with military capability and not just shooting missiles from afar.
I agree. The strikes, I think, were very much a way for Israel to demonstrate its ability while also listening to the US and not miscalculating its retaliation. The nature of the strikes was purely military. There was no impact, there was no targets to oil and nuclear infrastructure, and it was conducted in sparsely populated areas. Satellite images, interestingly, show that there was significant damage to at least 4 structures in Iran used for missile production and air defense, which I agree demonstrates Israel's ability and also exposes Iran to any further aerial strikes. So just exposes its military capabilities a lot more.
I think that's a very interesting point just made there, because depending on how much surface-to-air missile systems they took out, they basically leave Iran very vulnerable to a second attack. And maybe that's a way of building deterrence when it comes to whatever eventual response, whether it be in rhetoric or in action, Iran may want to take.
Yeah, and just going back to how much of I think a lot of this was, again, just to reiterate, a way for them to show what they can do. A lot of these sites, like one site was previously linked to Iran's nuclear program. So, and there was another, satellite images showed some damage to a storage unit at the Abadan oil refinery based in Khuzestan, which is in the southwestern province of Iran. The CEO of the refinery, the officials have said that the refinery was not affected by these attacks, but it's just interesting to strategically or with precision choose these targets specifically, like exposing Iran to further attacks, but also listening to everyone, calculating this really well, and just seeing that they haven't actually targeted any energy infrastructure.
So, I mean, they sort of took the U.S. advice.
Yes.
Although in the manner of their choosing, of course, when it comes to which military targets and which means of executing kinetic action, well, that's all down to Israel. But, I mean, the attack took place after the departure of Secretary of State Anthony Blinken. I suppose the U.S. draws a sigh of relief on this one, that whatever Israel did, it is at least not conducive to that sort of escalatory tit-for-tat type scenario.
For sure. The U.S. confirmed that the operation was independent, but they agreed that it was coordinated in terms of scale and strategy. So, I'm sure the U.S. was insistent, especially with the elections around the corner. No one would want a war on their hands.
True. Now, I mean, as far as Israel is concerned, and spokesperson Daniel Hagari has said that the attacks were precise, they were targeted, and perhaps more importantly, from the Israeli point of view, they were complete. So that kind of puts an end to basically Israel's action for now. And the interesting thing is, what has been the sort of official Iranian reaction to this strike? What is the messaging from Tehran relative to how they view the attack and what they may do? Because at the end of the day, it's this sort of tit-for-tat scenario really depends on how each of the protagonists is going to be positioning themselves. So as far as Israel is concerned, they're done. What about Iran?
I think that's a very good question, because I think the messaging is a little different domestically and for just what they're presenting out to just internationally as well. So as for Ali Khamenei himself, he did not mince his words. What he said was that the viciousness, this is a quote, the viciousness of the Zionist regime should neither be overestimated nor underestimated. He added that Israel's strategic miscalculations should be countered. But Iran's president said that Iran should give an appropriate response, but that his country does not want war. So I think Iran has said, a lot of Iranian media has downplayed the events, but what's clear just for the international message is that they don't want war. While domestically, the top commander of Iran's Revolutionary Guards, Hossein Salami, has warned that Israel would face bitter consequences after its attack on Iranian military sites. But again, I think just at present, given the international messaging, I don't necessarily see them willing to retaliate further.
Yeah, I think that certainly in terms of market reaction and the price action that has followed, I mean, since the end of Monday trading, the beginning of today, there's an element there that obviously there's going to be a lot of rhetoric, and there's a message to give to the domestic population, and of course there's an international message that the market is taking in order to make a determination on risk, right, and whether risk is still present or not. So on that very matter of risk, Vincent, I mean, given what has been said, given how the market has reacted, it seems to me that the geopolitical bubble that we developed after the 1st of October missile attacks has been punctured. So a lot of air has come out, if you will, out of that bubble or that balloon. And we're now back to a situation in the market that prevailed before those attacks. So has that risk premium completely evaporated in your perspective?
In my perspective, perhaps the risk premium in terms of flat prices provided a respite to the market. But Harry, as you pointed out at the start of the podcast, the options market is showing a positive core skew on the Jan 25 Brent futures contract. So this means that insurance against upside risk is more expensive than insurance against downside risk. So suggesting that the risk premium has not evaporated entirely. Of course, as yes, the geopolitical risk bubble has been deflated. However, the situation in the Middle East is still quite volatile and fluid. The conflict persists. The recent events and Israel's relatively proportionate response against Iran was likely a concession to the US ahead of the election, as Mita mentioned earlier. However, flare-ups could happen again, and it's anyone's guess what Israel might do after November 5. Of course, Israel continues its operations in Lebanon and Gaza, and in fact has just passed legislation banning the UN Agency for Palestine, the UNRWA, from operating in the country. Of course, the strike on Iran may be a warning, a test of Iranian air defenses, and could be potentially a prequel to another attack after the US elections, as some analysts have stated. So whilst the most immediate concerns for the oil market has been addressed, there's still a lot of speculative anxiety around this conflict going forward.
Yeah. So I guess to sum up, we're not out of the woods just yet.
No.
So we'll see how far this status quo will last. Mita, would you agree with Vincent? So we're still facing a sort of oscillating geopolitical risk premium. Now, the amplitude of the oscillation, of course, remains to be determined, and that, of course, then gets reflected in prices. But, as far as you could tell, would you agree with that? We let a lot of air out of that geopolitical risk balloon, but, there's a lot still left there to keep markets going?
It definitely is. I would say it is unwise to say that there is no more geopolitical risk premium present in the market, with the war still very much at large. And I definitely think that the immediate risk, the reason what was keeping oil prices supported in the near term is definitely deflated. But there still will be a floor to oil prices, just because the war is still very much still happening in the Middle East.
Okay. So, that's for, in terms of the geopolitics, the recent events, where we stand. And as we were saying at the beginning of the show, that kind of puts us back to that pre-1st of October missile attack. And what were the market conditions then? Well, the market was facing down very poor economic realities. So with the known unknown of Israel's retaliation now resolved, the market is pretty much back to looking at these adverse economic realities, and these realities were weighing down on the price of oil, given their negative implications in terms of oil demand. This in the face of, as we know, robust supply growth in non-OPEC countries, and the possibility, of course, for the OPEC plus countries to return more barrels to the market at the end of the year. So, Vincent, now turning to the sort of macroeconomic narrative, of course, Europe is weak. We've known this. We've talked about this. The latest PMI data for the largest economies, Germany, France, has been, has been weak. These countries are struggling. But the real focus is really China, right? And China being the historical driver of industrial commodity demand growth, including oil, of course. Well, all eyes are going to be on China. So, could you take us through some of the the macroeconomic developments we've had in China, and what people are waiting for? Because at the end of the day, this is what is going to be moving the needle on oil demand, and it is certainly one of the elements. In terms of the demand outlook, where there are big differences in forecasts between the IEA and the OPEC Secretariat.
I'll mention a few things that we've been looking at pertaining to the macroeconomy in China. So most importantly, China's GDP growth in Q3 did come better than expected at 4.6% year on year. However, certainly not strong enough in our view to achieve a full year target growth of 5%, which is also the government's target growth rate as well. Next up, China's industrial profits declined by 27% year on year in September, which marks their steepest fall this year. More than just that, you have the stimulus measures that have been announced. Monetary policy easing has been significant recently with the repo rates cut alongside the reserve requirement ratio. But to have a monetary expansion, you also need a demand for credit. China has a really high savings rate compared to other developed economies, and if consumers and businesses are hesitant to invest, then this will not really happen. Indeed, monetary measures look like they will benefit the equity stock markets more so than the real economy. So for now, it would not necessarily improve oil demand just yet. Of course, this fiscal stimulus measures has been a disappointment to the market so far. They hope for stronger than expected announcements. Support was announced for local governments and state banks, but no strong measures were so far directed at consumption. And the IMF has warned that growth could have slipped below 4% if economic reforms were not implemented.
That's really, just sorry to interrupt you there, but I mean, the message from the IMF, especially in terms of not only stimulus measures but reform of the economy, that's a fairly dire one because if we think about it, and we're saying that they're going to struggle to achieve a full year target of growth at 5%, given what's happening, and the IMF comes out and says, well, without imminent reform, that growth rate could slip below 4%. I don't know how fast the Chinese government is going to be able to move on reforms or measures, but that's a pretty dire prediction, when it comes to obviously one of the economies that contributes most to industrial commodity demand growth, as we said earlier. So.
Yeah, certainly, and that also perhaps underscores how China's government might have perceived this as an urgent matter, hence announcing these stimulus measures, well aware of the market's perception. And of course, speaking of this, the measures do open a door for further policy support, something that market's looking at as the meeting of the Politburo Standing Committee next week, same week as the US elections. It's China's top legislative body, and markets will be closely watching for cues of further fiscal stimulus measures. And of course, we have the structural changes that are happening.
Let's talk a little bit more about those because outside of macroeconomic policy and what the Chinese government could do, whenever that's going to produce an impact, in my view, probably not before, somewhere between Q1 and Q2 of next year. But something very interesting that's happening, partially by design, is the transition in fuel use in China. So whether it's electrification of the car fleet or use of gas. So can you tell us a little bit more about that?
Yes, so there's rapid EV penetration in China that's increasing every year, and of course China's moving towards more electrification of its road transport. So of course that's going to be hampering China's oil demand growth, with people saying that that's going to help China reach its peak fuel demand much quicker. So something we see recently is trucks are using more LNG as fuel instead of diesel, which is helping China reach peak diesel demand quickly, because estimates are showing that the substitution of trucks in China using LNG instead of diesel has already displaced around 4% of 2023 diesel demand, which all of this signals less demand for diesel, less demand for gasoline, and with the weakening refinery margins, it's going to hit the bottom line for Chinese refiners. And I believe just this morning, Sinopec also posted some, let's say, not so optimistic results.
Yeah, no, definitely. Clearly, we're seeing signs where Chinese crude demand. Now, of course, it's always hard to, to associate Chinese crude demand with the level of Chinese crude imports because, China does sometimes import for just security of supply or restocking reasons. But these developments certainly play into the operating rates of refineries, and as a result of that, we've seen, Sinopec this morning was announcing poor profitability, and so we may see some of the I don't know if it's going to affect equally the private or the teapot sector and the state-owned majors, but I mean, if the bigger outfits, if you will, are already cautioning, then it's quite likely that we're going to see the other segments in terms of the refining landscape be equally affected by these poor margins. Now, I mean, so that's China basically missing the target on growth this year. Stimulus measures that are falling short of the necessary mark, warnings by the IMF, structural transitions in terms of fuel use, I called by design. I mean, really, the Chinese government has been pushing this. They've been subsidizing their EV industry, which is in overcapacity, and making obviously cheap EVs for the population to adopt. Now, in as much as China is certainly an important factor, the other big economy that concerns us is the US. So when we think about macroeconomic realities, and we said that these macroeconomic realities are poor, and this may sound a little bit counterintuitive, but the macroeconomic realities in the US may be looking good, but how do we interpret them in this context of adverse conditions for the oil price? So Mita,
Yes.
let's talk about the U.S. I mean, they've done better relative to the rest of the world, right? And so let's see what that means. So what's going on?
So yes, the US economy has done a lot better relative to the rest of the world in a case of US economic exceptionalism. The IMF, in its latest World Economic Outlook, raised its 2024 and 2025 economic growth forecasts for the US. And I believe the US is the only developed country the IMF has done this for. So a soft landing seems very possible from this point onwards. And with respect to the financial markets right now, there are two concerns stemming from US data surprising to the upside. The first being higher real rates. So looking at inflation-protected treasuries, which are a good proxy for real rates, these have been moving up, which could push the nominal interest rate further, especially with market-based inflation measures, such as the 10-year break-even inflation rate, remaining more static in this period. If the economy is this strong, the Fed may rethink its pace for the easing, or just like it may rethink its choice relative to the pace at which it cuts interest rates.
Let's pause there. That's a very interesting point, because up until now, the market consensus has been pretty much consecutive Fed rate cuts. So you mentioned the word exceptionalism, and this has often been used in various instances to qualify the US. So when we're talking about exceptionalism, we're talking here on a relative basis, where obviously when it comes to PMI data, when it comes to the hard data, retail sales, etc., things are going better in the US and employment markets as well. So labor market data is quite strong. What if the Fed starts thinking about a pause? So everyone's quite convinced that at the next FOMC meeting there will be a cut. But what about afterwards, right?
Yeah.
So I think that that's going to be interesting. So we're going to get labor market data or payroll data this Friday, right? Is there anything we could say about that? In terms of Fed decision making, it's probably the consensus is looking for a weaker number this month.
So we might get a weaker number this month, but I don't think the Fed's gonna care too much. It's not gonna be like outright rate cuts, like we're going back to what the market was predicting initially, because this month has been a bit of an outlier because of the hurricanes and the strike in Boeing. So because of that, the Fed may not really care too much about data to the
So probably
downside.
look past the weaker data, right?
But data to the upside is going to keep feeding into this narrative that I've just talked about. So that would further cement the market's view that we're going to see a slowdown, or just a more patient view of the Fed in terms of its pace for further rate cuts.
I mean, that's interesting because that's that sort of dynamic that you discuss about, when we look at the decomposition of yields in between like how the nominal yield has been moving in relation to inflation expectations or market-based measures of inflation expectations, the tips rate,
Yes.
tips rate going up, and that's really the kind of environment for a stronger dollar, isn't it?
Yes, and in terms of just bringing things back to oil, so while the correlation between a stronger dollar and weaker oil, like the inverse correlation is not as robust as it used to be, just having a stronger dollar for that long, for a lot longer, is still not going to be great for oil. It's still, just because the oil is a risk asset denominated in the dollar, it might continue to add bearish pressure to oil.
Well, certainly have trade balance implications for a number of countries. If they are facing a stronger dollar, their purchases in energy they're going to be that much more expensive. If their domestic currency is weakening.
Exactly.
Now, I mean, moving away from the economic data, there's a big elephant in the room, a little more than a week away, and that's the presidential election. So, how does that feed into the recent macro thinking, or what has been happening around that? Because I mean, there's been a lot of people talking about what would happen in the case of either one of the candidates, taking the spot of president, but. These I guess these developments, and we still have to get to the election, but they've been leading to some market positioning and some changes.
Yes. So we see the market pricing in the rising volatility ahead of the election, and betting markets are giving Mr. Trump a lead over Vice President Kamala Harris. These markets are not to be confused by national polls, but just looking at these markets specifically, Trump's policies are expected to add more to the US national debt, with a think tank, the Committee of Responsible Federal Budget, putting the expected figure for Trump's policies at 7.5 trillion. This is on top of the current $35.6 trillion in the US national debt. Whereas Kamala Harris is expected to add $3.5 trillion to the national debt. So due to this, it's leading this expectation, the fact that betting markets are giving Trump that advantage, is leading to a lot more portfolio hedging and the sale of bonds, the flow of which is further pushing up yields. Just to dial back to the first point that I mentioned, the increase in nominal yields, which may again point to a stronger dollar and just the Fed being more reluctant to cut rates. And
I mean, that's an interesting point because you have now people taking a view on the elections, right? So we heard a lot about these Trump inflationary trades, but I've looked at the 5-year break-evens, 10-year break-evens, the 5-year forward. None of these measures, at least at the time when the betting market started giving the advantage to Donald Trump, have suddenly jumped. As you're saying, their movement has been relatively static, maybe slightly drifting upwards. The real rate has been the mover in terms of yield. So this is where we come back to issues of flow, right?
Yes.
And so if you're taking a view and you are hedging your portfolio, you're dumping bonds, maybe looking to a Trump victory that would be more advantageous for equity markets, extend the tax cuts that have been put in place. Who knows, maybe even reduce corporate taxes further. All that is positive equity. So you have a reshuffling in your portfolio, and those flows then are the ones that are now, at least in the short term, driving the yields higher. Now, of course, it doesn't mean that eventually inflation expectations will not start incorporating what it actually means to have a Trump presidency when he gets elected. But that is something for a future development. You can use oil as you use gold as your inflation hedge. But right now, I think we have a lot of people taking a view and rearranging their portfolios accordingly.
yes.
But are there any additional Trumps question marks that we could talk about? I mean, it's just not about adding debt, right?
I think that's a very good point, because a lot of just what we were just talking about, the geopolitical risk premium in oil, and all of that's going to shift as well post 5th November, with both the candidates right now having a very different view of foreign policy and having very different. I think the world's also expecting them to look at foreign policy very differently. So a potential Trump presidency he has a worse relationship with President Zelensky at this point, with the Republicans recently accusing President Zelensky of election interference. And his record has also been very pro-Israeli. It's going to be interesting to see what that has to entail with just the war in the Middle East, where Kamala Harris has been, in some instances, a bit more, has shown sympathies to Palestine more than Trump has. So all of that is going to shift as well. And yeah, I guess that is a key component of why this is still such an elephant in the room.
Yeah, no, I mean, definitely. No, we have the current macroeconomic realities. Obviously, exceptionalism, Fed maybe taking it a little bit slower. We're now having people taking views on what it would mean debt-wise, what a Trump presidency would mean in terms of debt and implications. But I suppose that if he is reelected, and of course we'll do a special on this after elections, foreign policy choices, and they could be, of course, of a political nature. And you're mentioning relations with various countries, and they range from Russia to Ukraine to Saudi Arabia to China, and of course Israel. So each one of these political relations and how Trump handles them relative to how they were handled under a Biden-Harris administration, well, that could open a whole new can of worms in terms of which way markets are going to go, not just oil markets, of course, but other markets as well. Now, having said all of this, so between geopolitical risk premia, macroeconomic realities, we get to our famous crystal ball moment, right? And that is certainly an opportunity for us to at least opine with the pundits out there on where we think oil prices are going. So, Mita, what's your view for the end of the week, and what are your views for the end of the year?
So for this week, in our Oil Insights weekly Brent forecast, which is available on LinkedIn, I put out the view that Brent is likely to settle between $68 and $71 by the end of the week in a more bearish view. I definitely believe that the $60 handle in the near term will be frequented, but also fought against again in the near term. But I do see prices falling in the high $60 handles by the end of the year, with OPEC barrels coming back online and the weaker demand outlook.
Okay, interesting. So we got a bearish slant here. Vincent, are you of the same disposition? I know the raging bull within you sometimes tends to have the more enthusiastic view amongst us. And but what are your thoughts right now, at least in the short term?
Certainly, there is a raging bull, but it has to also be pragmatic as well. I do agree with Mila that.
So you have a pragmatic bear on one shoulder and a raging bull on the other, whispering into your ears. So what are they telling you?
It's saying that the 60s will be frequented, but also quite frequently resisted against. We did see last month Brent tested that 68, 69 level, but was quickly lifted back up to the 70s. There's a good probability that Brent will stay above the $70 support level. Of course, you have Middle Eastern geopolitical risk remaining omnipresent, and I'm looking at the Brent spreads, which have remained extremely robust even during the recent sell-offs in the past few months. Not only in the front spreads around 30 to 40 cents, but it seems that the market might have priced in the prospect of increased OPEC barrels in 2025, which is reflected in the forward curve, which is showing just around 10 cents for the monthly 2025 Brent future spreads. So it's lightly backwardated, that's been accounted for, and also in the fact that lower outright flat price is prime SPR refill territory. You had the DOE coming out recently saying there's a 3 million barrel buyback. But also we'll be looking out for whether the fact that the Kazakhstan, Russia and Iraq, whether or not their compensation plans can be fulfilled, and that will support crude oil prices.
So I'm somewhere in between you two, or I mean, certainly on the short term, I agree, and this is where, again, there's a certain momentum in the market right now, and there's still a lot of uncertainty. and the macroeconomic realities, in my opinion, are gonna prevail. So building on the momentum that we have, this obviously can lead us to a $60 handle. So we may dip into the 68, 67 possibly. Now there are some bigger bears out there that are calling declines in prices to $50, but again, those are sort of comparative static exercises. The market's dynamic. We've postulated the potential return of OPEC plus barrels by the end of the year. There's no guarantee because OPEC itself has said that the return of barrels is conditional on market conditions, right? So as these market conditions change, there is no guarantee that we're going to have a reinstatement of production and a curtailment of these famous voluntary reductions that they have had in place for some time now. So there is obviously that element of uncertainty. The other thing, thank you, Vincent, that you rightly highlighted is, spreads on the curve in futures are relatively strong at the front, but we've also seen some of the strength reflected in the physical diffs as well. So we have a situation where, globally speaking, global crude stocks are relatively low. When OPEC looks at the metrics, it often looks at the average for the OECD countries, the famous 5-year average for oil inventories. Latest data from the International Energy Agency on these inventories for the OECD is putting them at the bottom of the 5-year range. So even if we did get more supply out of OPEC, it's not going to be a lot, and it's going to be adding to a low base in inventories. So we haven't seen those spreads suddenly like shift into contango, announcing that you suddenly have to move a lot of surplus oil into storage. So I'm sort of thinking that along the lines of, we have a certain momentum now that could allow us to grab that 60 handle, but that $70 sort of baseline view is not to be completely discounted, right? Mm-hmm. So if we had to choose between 50 and 70 for year end, I'm a little bit more on the 70 side. But as I said, there's a number of relatively big grizzly bears on the prowl right now who are announcing numbers as low as 50, and I'm sure they'll be outdone by even greater bears. But having said that, I think at least in the short term, there is certainly more weakness to prevail. Now, we talked a lot about crude. We talked a lot about geopolitics. We would be remiss if we didn't do our product of the week. And so I'm going to turn back to Mita. So this week, one product has really caught our eye, and that's high sulfur fuel oil. And high sulfur fuel oil has been really performing, especially on a crack basis. And so we wanted to take a quick look in terms of what were the price dynamics there. And so Mita, I know you've been following this quite closely. Can you give us a review of what's been happening, flat price-wise, crack-wise?
Yes. So high sulfur fuel oil has been really interesting because a lot of the strength it's been a strong market, but the strength has been concentrated in Europe. So in the Med, for example, the HSFO crack versus Brent has been positive for the past 6 sessions. And a lot of the strength is because of rising Egyptian demand year on year, while their gas output has been lower and LNG has been really expensive. So that's prompted them to switch to fuel oil. At the same time, there's been ongoing run cuts and seasonal maintenance in the region. So that's propped up prices even further. In Northwest Europe, which is the market I've looked at closely, the barge crack, the M1 3.5% barge crack has been incredibly strong since the beginning of September, and it reached an all-time high for the M1 last week. The Balma contract has flipped to positive handles, and the M1 was at negative 2.45 on the 23rd of October, and it's currently just a touch lower at negative 3.25 dollars per barrel. Mm-hmm. The Atlantic Basin strength, so this strength is partly due to increased container activity from the US as US retailers restock inventory ahead of the US elections. While in Europe, I've heard reports of relative supply tightness, and shipping reports highlight that fuel oil exports from Europe to Singapore increased substantially to nearly 3.7 million barrels, which was 72% above the 3-month moving average. This was just in September, which coincided with this rise in European NWE the barge crack.
So we almost had like a bit of a double whammy because we had maintenance at refineries in Europe, of course, so curtailing the supply of fuel oil. But if at the same time there has been if the tanker trackers are telling us that in September there's been a significant volume that's been exported out, then you sort of leave October, with less supply available domestically, and that certainly can help boost the crack. This obviously, in the context of an oil price that has been on a downtrend, right?
Exactly. So just looking at exact figures, bunker fuel sales in Rotterdam in Q3 2024 were 3.4% higher year on year, with most of this growth coming from high sulphur fuel oil, which increased 19% year on year. That has primarily been why it's been so strong. So just looking at the East as well as a comparison, the M1 380 CSD crack against Brent has also been really strong, moving from negative 11.5 on 5th September to negative $3 per barrel on the 29th of October. But because of how strong the Rotterdam barges have been, the East-West remains pressured, dropping from $16.75 per metric ton on 11th September to negative 20 at the end of September. So that closely mirrors, it goes against the strength in HSFO, in European HSFO. The East-West has since found more support, but it's still just at $1.25 per metric ton.
Okay. And very quickly, have there been really certain market participants that have been more active than others in terms of the recent price action?
So as per our data, we've seen trade houses being active participants in the NOV 3.5% barge crack, with Onyx identifying over 470 kilobarrels of trade house buying over the past month, alongside some end user buying. At the same time, the NOV deck 3.5 barges, that's the front month spread, saw over 1 million barrels of trade house buying at the same time. So these trade houses have been more active participants.
So maybe, if they're buying the spreads, perhaps there's an anticipation there that, maybe the relative supply tightness is going to prevail for a little bit longer, possibly.
Interestingly, yes, I think...
Not too long, but again, it's because obviously when refiners come back and start producing more fuel oil, when they ramp up their throughputs post-maintenance, we're going to get more oil. But
exactly,
it's just interesting to see that people are bidding with spreads for the product, because it typically tends to lean towards a more bullish view. Although I personally would say that supply conditions are likely to ease when refiners are all back up and running, right?
I agree. So the US has already started increasing refinery runs after its seasonal maintenance. It's increasing product output, and a lot of it has increased its fuel oil stocks. So global fuel oil stocks are now almost back in the historical range after a previous decline that was seen for most of October. So it is, in my view, quite likely that we're going to see supply conditions ease in November.
Okay. Well, that pretty much brings us to the end of our show. We're at the sort of concluding remarks portion of our podcast. I think Vincent, do you want to kick us off? Are there things that you're looking at that for this week or even further out?
Yeah, so some ones to watch this week are definitely the US GDP numbers coming out on Wednesday, and that'll be interesting. We'll see if this will continue the story of American exceptionalism. American economic exceptionalism, which... Of course. In combination with, you have the non-farm payrolls coming out on Friday, which would likely dictate or influence what the Fed might do in its next meeting. But of course, you have the official PMI data from China on Thursday, and given China's important to the macro narrative, we will be very closely monitoring these figures. The PMI has shown 5 consecutive months of contraction, so it'll be interesting to see what the figures are this time around.
Okay. Mita?
I agree with everything Vincent said. To add to that, we'd also be looking at this week's U.S. weekly oil inventories by the EIA. That's scheduled for Wednesday, that's tomorrow. In particular, we'll be keeping an eye out on crude oil stocks in the U.S. These have been trending around as you mentioned, at the lower end of the recent 5-year range. And with refiners ramping up runs again, as mentioned for fuel oil, it'd be interesting to see how this changes this week and in the coming weeks.
So we actually could still live with very low crude oil inventories in the U.S. So that whole inventory narrative that is not yet really reaching the sort of front page of the market's newspaper, if I could put it that way, maybe one of those elements that will help, as we were talking earlier, to provide some support to prices. As for myself, I'm thinking about a little outlier geopolitical risk premium that we haven't talked about yet. And that's basically North Korean troops joining Russia to do what? I don't know. To be deployed how? I do not know. But certainly North Korea has decided to lend a hand by contributing troops to Russia in their war in Ukraine. It's an interesting development because you're now having foreign troops join hand with Russian troops in the war in Ukraine. What is that going to mean in terms of European or U.S. support to Ukraine? There are a lot of question marks there. But it is an interesting development. It may mean something, it may not mean something. It could be symbolic. We don't know the purpose of these troops and how they may or may not be used, but it may simply be an element of signaling between North Korea and Russia and their relative, obviously, proximity with each other, both politically and otherwise. So yeah, North Korean troops in joining forces with Russia. This may be a sort of a slow burn story, and of course, everything could change after the U.S. presidential elections come November. If President Trump were to be elected, the dynamics would certainly, and I don't think I'm breaking any new ground here, be very different with Russia and the possibilities of whatever solution emerges relative to Biden or the continuation of Biden-Harris type foreign policy that is likely to be in place should Kamala Harris become president. So that basically concludes our show. Well, Vincent and Mita, thank you very much for joining me. And just a reminder, smash that like button, subscribe, and we'll see you the next time. Thank you very much.